I would like to welcome you all to the launch webinar for the SSF Low Carbon Economy Report. We are very happy to welcome so many participants to this event, and we much look forward to presenting to you our latest report, Financing the Low Carbon Economy. My name is Sabine Döbli. I'm the CEO of Swiss Sustainable Finance, and I will guide you through today's webinar. But before we start, let me just quickly inform you about some technical aspects of today's webinar. We do have the Q&A option active, and we encourage you to use it. We'll do our best to answer as many questions as possible at the end of the event. By the way, you can also tune into our YouTube live stream. You just add /live at the end. A recording of this event and also the presentation will be available online afterwards. So in case you do need to leave us early or you join us late, you can always watch the rest of the event later. Even with the difficulties that the current pandemic poses to all of us, we think that climate change still remains probably the biggest challenge for our world going forward. Switzerland aims to halve its greenhouse gas emissions by 2030 and bring them down to net zero by 2050. It's clear that the financial sector plays a crucial role in achieving these national, but also in achieving global climate goals. So far, an overview on how the financial sector can support this objective has been missing, an encompassing overview. And this is why we at Swiss Sustainable Finance have prepared this encompassing compendium on relevant finance instruments that support the transition to a low carbon economy. The report, named Financing Instruments for Low Carbon Economy, has three main objectives. In it, we present different finance instruments and their mechanisms. We illustrate their implementation through concrete case studies, and we analyze existing barriers that we see in the market and also make concrete recommendations on how they could be addressed. We are quite proud to present this publication to you, building on the know-how of our broad network. It covers 14 different instruments and 2 additional levers, and it contains 8 case studies. It results in a report of totally over 100 pages. You will learn more about it in the course of the webinar. But let me now briefly introduce the different speakers to you. First, Anja Bodman, Project Manager at SSF, will present the different elements and main conclusions of the report. Then we invite 3 guest speakers to give us an outside perspective on the topic. Jörg Gasser, CEO Swiss Banking, will talk about how banks can contribute to a low-carbon world. He's followed by Urs Arter, Deputy CEO and Divisional Head of Insurance Strategy and Regulation at the Swiss Insurance Association. He will explain the Swiss insurance industry's reaction to climate change. And as our last speaker, we will hear Bjarne Steffen, Senior Researcher and Lecturer at ETH Zurich, and by the way, Professor for Climate Finance and Policy as of 1st of January next year. We are very pleased to have him provide an academic view on the role of policy instruments for climate finance. So let me now hand over to Anja for the presentation of the report.
Thank you, Sabine, for this introduction on the report and the webinar. As already mentioned, we are very happy to launch this publication today. But before I give you more details about the content of the report, I want to explain why SSF decided to work on the topic of finance instruments for a low carbon economy and why we dedicated such an encompassing publication to it. The fundamental starting point was, not surprisingly, the Paris Agreement, but also the revision of the Swiss CO2 law, which actually was adopted this September and sets more ambitious targets for Switzerland. And this Paris Agreement both stipulate that financial flows need to align with the target of keeping global temperature increases well below 2 degrees, or ideally at 1.5 degrees. To reach this 1.5 degree target, it's not just about aligning financial flows, but the financial industry is increasingly expected to, and has also committed itself to, contributing to mobilizing the considerable amount of capital that is needed to transform our economic systems. The IPCC, the Intergovernmental Panel on Climate Change, calculated that 3.5 billion of investments are needed every year in order to transform the world's energy system to meet the 1.5 degree target. And this figure doesn't even include investments needed in other sectors. So we see that our economy and our societies are faced with a very large task. SSF is convinced that the finance industry has an important role to play for this. And with our broad network, we felt that we were predestined to really support this transition by providing an expanded view on low carbon financing instruments and show how every player can make a contribution to turning the world economy around on a path to a low carbon future. Now, in the report, we therefore really decided to look beyond listed investments at secondary markets, which are often in the focus of the public debate. And we aimed to cover here a broader range of financing instruments and provide a toolbox for all kinds of actors. The report and its contents were driven in a bottom-up fashion. SSF, with the guidance of a steering committee, defined and outlined a range of topics, and then we launched a call for contributions among our network to receive expert inputs on the instruments that practitioners in the market are already using. And so to reunite the knowledge that is already in the market in the field of low carbon financing instruments. This call for contributions resulted in a total of 24 articles which were submitted, written by 44 different authors. And we are very proud to have such a vibrant and active network, which reunites a considerable amount of expertise and which you can find in the report published today. Then on this slide, you can see an overview chart, which you can also find in the introduction chapter of the report. And it's not important that you can read all these details here, but what we wanted to show is that in the report, we cover different instruments. And you can see the instruments here in the dark blue circles. We map these instruments within the financial system and aim to illustrate that today, low carbon finance instruments are already available for many different kinds of actors, and they cover different types of financial flows. And this, in our opinion, is crucial since ultimately the whole financial system needs to work together to make a contribution and leverage the potential. For example, on the top of the chart, you can see asset owners, including pension funds, foundations, and also private clients, and in the insurance companies. Then if we move further towards the center of the chart, we have asset managers and wealth managers, but also banks who play an important role through their lending businesses. On the left, service providers and other supporting functions such as the stock exchange is mapped. And then if we go further to the bottom of the report, we also see the real economy and the government, both of which are also discussed on multiple occasions within this report. And we think this is key because, in our view, the responsibility for mobilizing this huge amount of capital that is needed lies with all these players, and connecting them and connecting the different instruments is really important to have the desired effect at the required pace. Now, some more information on the actual content of the report. On this slide, you see the instruments covered. Of course, I can't go into detail on all the instruments. For that, I recommend you look into the report because the authors that wrote these chapters really provided detailed information on the instruments, but also the underlying mechanisms, areas of application and improvement for each instrument. The first set of chapters, 2 to 4, which you see on this slide, cover well-known instruments that relate to listed equity market investments, such as thematic equity funds, but also climate engagement for listed equities and bonds. These are instruments that we consider as quite mature in the Swiss market, which you can see on the column in the right of the slides, where we also rated these instruments according to the maturity that we see in the Swiss market. Then going further down, we also cover instruments that mobilize new capital for low carbon solutions, namely green bonds, which are well established globally, but here we do see considerable potential for the Swiss market and Swiss players to further take up this instrument. Then we also in the report have multiple chapters on the topic of real estate, and real estate is of course very important for Switzerland to reach its climate goals. And the report covers on one hand real estate investments, both direct and indirect, but we also looked at sustainable mortgage business. And while direct and indirect real estate investments are quite a mature practice in Switzerland, we so far do not see that many innovative products related to, for example, energy efficiency mortgages in the market. And we do see considerable potential here also to further this instrument. At the bottom, chapters 8 and 9, you see instruments that cover private markets, both early stage investments through venture capital, but also later stage private equity investments. And we think that these instruments in particular have a considerable potential for leverage to promote low carbon solutions, because they can directly finance new low carbon projects and exercise a considerable amount of influence on the company or project at stake. Then on this slide, you can see the more innovative and less well-established instruments that are also part of this compendium. And we really wanted to show the broad toolbox for different players. And at the top, you see this includes, for example, energy efficiency insurance models, but also energy performance contracting or community finance models. And all of these provide a clear investment case specifically for renewable energy and energy efficiency. And there's also a chapter on carbon credit markets and the use of carbon pricing, as well as chapters that involve the government more actively, for example, blended finance, but also the instrument of a green state investment bank, which so far does not exist in Switzerland, but is worth a discussion. At the end, we also have chapters 16 and 17, which cover more general level levers for change and address the framework within which financial players act. That's on one hand, transformation capital, which really analyzes the concepts that are prevalent in the financial industry, but also environmental policy, which does have an important effect on the outcome that these financial instruments can achieve. So when preparing this report, it became clear to us that there is already a very broad toolbox available for market players to work with, but also to further develop and scale ultimately. However, we also noted that multiple barriers do exist and arise for multiple instruments, and that these barriers may actually then hinder the necessary scaling of these solutions. A challenge that most of us working in the field are well aware of are data gaps in the field of climate data, but also a lack of standards and definitions for climate-friendly investments. Then we also recommend further work on building know-how and expertise in low-carbon finance. And while doing so, we encourage financial players to view climate change in a holistic manner and on a long term, and across their entire investment change. And only by this can we really also aim for the change that is needed. Finally, the last two arrows you see on this slide refer to the frameworks that do still need to be improved in order for the financial instruments to have the desired effect. This requires adequate government action. For example, accurate pricing signals, notably an accurate CO2 price, which ensures that low carbon technologies become the new normal and carbon intensive technologies fade out, or also in some specific cases, even incentives and de-risking for particularly risky investments where necessary. So with this very brief and quick overview on the report, I hope that you will be interested in digging deeper and diving into some of the chapters and having a look at the report, which is available as of today. With that, I hand back the word to Sabina.
Thank you, Anja, for providing insights into the content of the report. Well, having heard Anja's input, we would like to insert a quick poll to gain your view on the following question. where do you see the greatest lever for increasing the finance sector's contribution to a low-carbon economy? Does it, in your view, lie with institutional asset owners that would change their preferences? Is it with financial market players that offer the right kind of products? Is it actually the real economy that has to move and adapt their processes? Or is it the government that needs to adapt the frameworks? Please go ahead and select your answer. We'll give you a few seconds to do so. I assume quite a few of you have now made their choice, so let's see what the result is. Okay, the picture is quite clear, although I see close results for financial market players clearly coming first. So obviously the audience think that it's now upon them to use all the tools that we show here, but we also have quite some answers for the government. Obviously, you are of the opinion that changing frameworks are also key. And then the other answers go to institutional investors in the third rank, and then the real economy. Maybe quite surprising to see that the financial community in this call does not see the main responsibility with the real economy, where things also have to change, but it clearly gives a signal that we need to move on, that's for sure. So thank you for your input. Now, we move on to our guest speakers from financial associations and academia. And I would like to first give the word to Jörg Gasser, the CEO of Swiss Banking.
Thank you very much, Sabine. As we could have seen from the survey, the pressure is on. The banks and the insurances are really on the forefront with regards to the overall all-encompassing questions concerning climate change. And I'm very happy to be here and try to, within these 7 minutes that I have at my disposal, try to give a very extremely short overview of what we try to do. The Swiss Financial Center has been and still is, or at least tries to be, a front runner in sustainable finance. Many global firsts in this area have been pioneered in Switzerland since the 80s. And building on various financial sector initiatives and given suitable framework conditions, we believe indeed that Switzerland can become a global leader in sustainable finance, thus creating a major opportunity for its financial service industry. So it is an opportunity that needs to be seized. And that is one of the reasons why sustainable finance has been a priority for the Swiss Bankers Association for about 2 years. And we have a close working relationship with Swiss Sustainable Finance, which we cherish and which we highly appreciate. In this cooperation, the Swiss Bankers Association focuses on the less glamorous but equally important framework conditions for sustainable finance. Swiss banking is very much committed to the Paris Climate Convention and the net zero target by 2050. We also support the version of the CO2 law passed by the councils a few weeks ago, and all actors are addressed to make their contribution. So not only the financial sector, as it might be, as it has also been shown in the survey, but also the real economy, of course. And I can only support the statement of the authors in the preface of this excellent report, that only if we join forces and apply them at scale, both within Switzerland and beyond, will we be able to generate the required change. Now, with regard to Switzerland, Switzerland is geographically a dwarf, as you can see. Of the total land area of the earth, our country accounts only for just 0.27 per mil. At the same time, Switzerland is an economic powerhouse, a giant. Switzerland is one of the 20 largest economies in the world. Or let's take Switzerland's market share of cross-border assets under management. Here, Switzerland's share is 1,000 times higher than the country's area, namely 27%. More than a quarter of the world's cross-border assets under management are managed from Switzerland by our banks. On this basis, of course, the banks can and actually have to make a contribution. If we succeed in setting benchmarks in terms of products and advice on sustainability, our influence will be far greater. Switzerland's economic size also shows that sustainability and competitiveness are not mutually exclusive, and I think this is one of the main driving forces for the change. The transition to a CO2 neutral economy requires substantial additional investments from both the private and the public sectors. The importance of innovative solutions cannot be overemphasized, and it is also part of the DNA of the Swiss Financial Center, especially in the field of sustainable finance. Swiss sustainable finance provides important groundwork and support for the entire financial center in this area. This is particularly evident in this report published today. The report showcases a wide array of finance instruments that help channel funding into the solutions necessary for the transition to low carbon economy. In addition, the innovative solutions and the willingness of investors, appropriate framework conditions are required. The political framework conditions must give the Swiss Financial Center enough flexibility to be able to turn sustainable finance into a competitive advantage. With regard to transparency, banks advocate for greater transparency concerning the risks associated with ESG factors. These transparency rules must be internationally coordinated, include the entire economy, and be commensurate with the size of the financial institution. To promote the uptake of sustainable investments, the financial center is reliant on better market access, up-to-date investment rules for institutional investors, and tax relief on trading operations. External factors must be directly priced into the real economic activities in a market-based approach. That means basically through incentive taxes combined with market-oriented measures to encourage the reduction of negative external factors. With regard to the lending business, there must be, from our point of view, no interference between ESG criteria and capital adequacy requirements. The SBA clearly rejects restrictions on bans on the financing of activities that are perfectly legal so far. Capital markets and insurances, the issue of financial instruments, including those compatible with the ESG criteria, must be granted tax relief. All 14 financial instruments that have been presented here in the report and the 2 additional levers outlined in the report can be assigned to these categories and require the best possible framework conditions to develop their full potential. The Swiss Bankers Association is fully committed to these being implemented. Achieving sustainability goals requires a change in the behavior of economic actors. It requires measures to influence the behavior of economic actors away from unsustainable activities towards more environmentally friendly and socially responsible practices. Framework conditions cover much more than legal conditions. Framework conditions cover the full palette of potential approaches. This also includes price mechanisms, in other words, positive or negative financial incentives, transparency requirements, behavioral approaches such as nudging, and, if needed, bans. Swiss banking is convinced that industry standards and initiatives are much more effective than legislation and can support innovation in a much more effective way. So from that point of view, I think it is very important that we set the framework conditions right so that we can continue to be successful and bridge the gap between the expectation and what really is going to happen in the field. Thank you very much.
Thank you, Jörg, for showing us how Swiss banking sees the role of the different players and also how you encourage your members to contribute to this change. But let me follow up with a question. You stressed the framework conditions quite a lot. Now, seeing this palette of instruments, don't you think they could even be used much more broadly under the given frameworks that we see right now?
There is probably no general answer to this question. We have unfortunately, we have become very accustomed to so-called workarounds, especially with regard to tax challenges and market access. This would most likely also affect some of the approaches presented in the study, especially, but not only, collective investment schemes. Workarounds lead to a shift in value creation. They increase complexity because you have to develop these workarounds, and ultimately also to a hurdle in the reallocation of existing capital flows. And of course, and the additional investments that are required for that. So optimal framework conditions must therefore be sought for existing and innovative new approaches, also in the context of our goal of becoming a leading international hub for sustainable finance in order to avoid these workarounds from happening.
Thank you, Jörg, for the additional comment. So maybe we can dive a bit deeper in the Q&A session. So now I would like to hand over to Urs Arter, Deputy CEO of the Swiss Insurance Association, for his contribution.
Yes, thank you very much for the opportunity to share our view on this important topic with you. The headline it shows is rather catchy, but sustainability is an important interest of the insurers. To make it obvious, you can think about the building insurance where the result is heavily influenced by the development of the ecology. I would like to give you some insights to our strategy regarding sustainability during the few minutes to come. You will see that the financial market in Switzerland is strongly moving forward on this topic. Who's the Swiss Insurance Association? It's the umbrella organization of the private insurance industry. The Swiss Insurance Association consists of roughly 80 primary insurers and reinsurers who account for 85% of the premiums generated in the Swiss market. As insurers, we insure, but we do have also significant assets under management, and therefore we are also asset managers. We are also an important investor in real estate. As highlighted in the SSF report, real estate accounts for around 1/4 of greenhouse gas emissions in Switzerland. As every company, also the Swiss Insurance Association does have a strategy. We do have one for the time between 2020 and 2024. Of course, we are here to create the most favorable conditions for its members. And therefore, optimizing the legal and the regulatory framework is one important part of it. It's about legal conditions in general. It's about supervision, but it's also about shaping the employer policy and professional education. And there we do have, in addition, two general topics that are focus points. One, of course, is the occupational pension system that has to be adapted to the demographic change. But the other one is anchoring sustainability and also enabling innovation. And therefore, it's one of the strong points we are moving forward during the years to come. We have 4 different goals. The goal 1 is that we are striving for a livable environment. We are, of course, aware we can't do that just for ourselves. We are enhancing the cooperation with policymakers, authorities, and other key stakeholders. But we believe that the market is moving forward on itself, and it has to be done with as less regulation as possible. The second goal is establishing guidelines for ESG criteria. Of course, it's for the asset management, but it's also in the underwriting, so in the risks we are taking on our balance sheet. And this is not so easy. In the first step, you might think, just write that. But that has to be done according to the expectation of your customers, as well as of the population overall. And that's something that is moving forward. So Let me make the example. If we decided to stop insuring fuel-driven cars by tomorrow, we could be doing that. We don't think that the Swiss population will cheer about that. That will be a major impact on the Swiss economy. Therefore, yes, in long term, probably that will be so, but our underwriting guidelines have to be moving forward according to the expectations of our customers as well as other stakeholders. Let me move to goal 3. Of course, we are doing our part in reducing the CO2 emissions and therefore influence the global warming in a positive way. Our commitment is given that the greenhouse gas emissions have to be reduced, and we support the federal government's climate policy. But still, global warming will be happening, and that has to be mitigated. And we are also here to mitigate the consequences of global warming, for example, in order to improve the situation of our building insurance. We are transparent on what we are doing, and we are having published for the first time last June an industry report where the efforts of the Swiss insurance members, 32 members, important members participated, is shown also with figures. We will continue with this report and will do so on an annual basis. The 32 members, they manage 94% of the assets under management of the Swiss insurers, and these already have 86% of their capital investment decisions taken along to ESG criteria. According to the SSF report, green bond issues are signaling their awareness of environmental risk, but also their willingness to exploit attractive low carbon opportunities. With more than this 86% of all capital investment decisions taking ESG criteria into account, the Swiss insurers attach particular emphasis on this point. But let me come to the regulatory point. I gave the statement that we believe as less regulation as possible, and it's also deregulation that has to be done where it is possible. For example, infrastructure investments are limited into within the alternative investment category, and we could be released on that, would ease the task to invest in green investments. Last point I would like to stress is global warming is happening. It has a climate impact on our building insurance. We want to mitigate that. And therefore, we have several initiatives by the private insurers where we try to make the situation, this is by the way on the next slide, for during the last years have been doing so and will be continuing that, where we make maps and show where you're exposed and how the risk could be reduced. The next thing will be a hail climatology map that will be published next year, always according with the federal government bodies. Therefore, overall, we believe it's an important topic. The Swiss economy is moving forward. It's taking it serious. We have important measures taking place, and we will be continuing this path. Thank you very much.
Thank you very much, Urs, for your input. That was a very insightful insight into what the insurance industry is actually performing. Let me also briefly ask you a question. In your presentation, you mainly referred to options to foster climate change mitigation in asset management and also in underwriting. But insurers are also large claims handlers. Are there also opportunities that you see in claims management related to climate change? Thank you, Urs.
That's a good question. there is certainly a lever in the future also in the claims management. Swiss insurance companies are paying on a daily basis roughly 140 million Swiss francs to their insured, and a large part of it is coming out of the non-life business. And now in claims handling, I believe there is a lever where we can, for people, for example, having the necessity to reinvest, the opportunity to show them that they could do that in a ecological friendly way. There are always different opportunities how they invest. And I think we could also be organizing attractive financial conditions for doing so. For the moment, we do have the priority on the asset management. The underwriting is coming up, but the claims management will be a topic in the future too. I think that's a good point.
Thank you for commenting on this topic. I would like to finish here with the Insurance Association and move on to our next speaker, Bjarne Steffen, Senior Lecturer and soon Professor at ETH. He will talk about the role of policy instruments.
Thank you, Sabine. Great to be here. I think it's an impressive report, which really showcases the breadth of instruments that have been developed by sustainable finance actors in Switzerland. And these actors, they act, of course, within a political framework. And policies are an important ingredient to make sure that sustainable finance really has an impact. So I'd like to share some thoughts on where the Swiss Financial Center stands in this regard. So I zoom in for government at the very bottom of the chart that Anja showed earlier to discuss the role of policy in sustainable finance. Essentially, there's two types of policies. There's first is general climate policies, environmental policies, which address polluting sectors like energy to enable low carbon business cases and make green assets investable in the first place. These are things like carbon pricing, for instance, subsidies for new renewables. There's a great chapter by Rudolf Rechsteiner in the report that discusses the state of these environmental policies in Switzerland. And then second, there are policies that address the financial sector, explicitly aiming at redirecting finance flow to low carbon investments. And these low carbon financial policies require also attention, I think, because they could help the development of sustainable finance market and maybe even more importantly, then ensure that sustainable finance delivers on climate impact. If we look at the OECD, we really saw an explosion of these types of policies with the Paris Agreement in 2015. In the Paris Agreement, the Article 2 has a political commitment to redirect finance and government increasingly act on it. What is shown here, it's the number of policies that are enacted. And you see governments, they do not just act with like soft information policies, such as government studies, but increasingly also with substantial policies, using government authority to set binding rules, and especially in the last 2 years, also using government organization to directly act on markets. That's the blue numbers on the bottom. If we compare countries, on the next slide, we see that Switzerland, compared to others, showed very little policy activity. There's essentially just one substantial policy in that category, provision of loan guarantees via the technology fund. And some other financial centers show much more momentum, like the United Kingdom, for instance, the EU level, also the United States, at least until 2016. Then since Trump took office, there's been no other policy on the US federal level, but that will very likely change under Biden administration again. So I think it's important for Switzerland to be aware that other countries are moving ahead, which I think also means that notwithstanding private sector activity, the attractiveness of the Swiss Financial Center for Sustainable Solutions could fall behind, or at least make it more difficult for the scaling of some of the financial instruments that are described in the report. So to make this a bit more concrete, I will show some examples for policies from OECD countries. First, policymakers, has been mentioned before also by the other speakers, they can be proactive in using their authority to mandate the disclosure of climate-related information and in defining binding terminologies. One important example is the French Energy Transition Law, Article 173, which increased carbon disclosure requirements for listed companies and newly introduced carbon reporting also for asset owners and investment managers. And as a consequence, more ESG data became available. And it also brought climate risk and ESG on board agendas of asset managers who newly had to disclose their approach and then request corresponding data from corporates and so on, including, by the way, at Swiss asset managers. We heard from quite some market players. As soon as they are also active in France, they have to comply. So this is an example for a regulatory measure that I think accelerated structural change within the financial sector more broadly. Another example is the EU taxonomy for green investments, which will become binding for green bonds. These types of regulations, they clearly increase the clarity of what is considered sustainable. It's not undisputed. For instance, potential issuers of green bonds might feel limited with respect to, okay, what can qualify as a green use of proceeds, if that's legally determined by taxonomy. But if we care about actual climate impact, I think it's important to prevent greenwashing, and such legal taxonomies, that's one way to achieve that. And in the end, that will also increase trust in green financial instruments, and so can help the long-term market prospect of a sustainable finance products, like many of the instruments in this study. A second pathway for policy is to leverage existing financial market activity of the public sector. For example, with borrowing via green bonds. I mean, now green bonds, they get increasingly popular in the private sector, but initially it was public actors that developed and pioneered the instrument, like the European Investment Bank and the Ile-de-France region early on. And later on, it was also sovereign issuers who played an important role in mainstreaming the instrument. Second example are investment guidelines for public funds, like public pension funds. For Switzerland, it's, for instance, estimated that the Swiss financial marketplace still invests about 4 times as much in fossil fuel-based power generation than it does in renewables, as per the PACTA study that came out last week. And public funds, they're actually quite an important part of these assets. Now, research on public pension funds, we see that it's a small minority. It's less than 20% who have any kind of coal divestment, thermal coal divestment policy, for instance. And given the asset under management, moving ahead here by public actors could make a difference. Finally, many countries also engage in dedicated market activity. Anya mentioned that before. It's on the next slide. Especially in project finance for novel technologies. There's green state investment banks, usual suspects like KfW, but also newly established players like the CEFC in Australia, Green State Investment Bank, which is purely market financed, lending at commercial rates, the International Climate Finance Accelerator in Luxembourg, recently InvestNL in Holland, and other examples. Of course, the mandate of such players matters, whether they complement or compete private activity, but I think it's definitely worth evaluating in which way such a policy could also help the Swiss sustainable finance marketplace. So in sum, I congratulate Swiss Sustainable Finance to the report. I think it really underlines the high momentum of private. I want to note that activity on the policy level is low, and the Swiss financial marketplace might benefit from also not falling too much behind other countries in that regard.
Thank you, Bjarne, for sharing the result of your research with us. I would like to follow up with a question. You bring examples of how the public sector can help mainstream climate finance market. Tell me, is it time for a green bond of the Swiss government?
Yeah, I think it could be a good time for a Swiss green bond, yes. There are already some on a cantonal level. Geneva, for example, issued one, I think. But having a green bond on the federal level could send a much stronger signal also to international markets. I mean, that's a bit what happened when Germany issued their first green bonds 2 months ago or so, I think, making big headlines, was massively oversubscribed, raising 6 billion or so. And obviously Swiss bonds, it's another cornerstone of a fixed income market. So having a Swiss green bond could further mainstream the instrument, position the Swiss marketplace in international sustainable finance. And one nice thing actually would also that it would force the Federal Council then to think about for what to use the proceeds, to come up with additional project to actually have a climate impact from a Swiss green bond. So I think it's something to consider, yes.
Well, thank you. Let's see where the journey goes in Switzerland with the green bond market specifically, but also with other government action. Well, all speakers were very disciplined, and we actually do have time to take some of the questions that I already saw in the Q&A section. And I would like to start with the first one that related to the methodology we applied to determine the different maturity levels of the instruments that we show in the report. You might recall that on 2 of Anja's slides, the long table, we showed the maturity level. Well, we have to say it's not a very thorough and firm methodology, but what we did is we looked at the existing level of expertise in the Swiss market and also the uptake, the actual uptake in the market, where we looked at absolute uptake, but also compared it to other countries. And we discussed this with our steering committee, and that's how we came to these ratings that should definitely give a direction, but are not set in stone, that's for sure. And we also had some debate about some of these ratings in the steering committee. So much about this methodology. We then have quite an interesting question from Carlos Sanchez. How do you see the aspirations of the UK in leading the sustainable finance markets? It was announced by Boris Johnson this week versus the Swiss market. Can we be like the UK? Can we compete with them on leading sustainable and maybe green finance markets? I would like to hand this question maybe to Jörg Gasser first. Jörg, what's your opinion on this?
Thank you, Sabine. It's a very good question. First of all, competition is always good, and to compete with the best ones is very enriching and makes us stronger. So from that point of view, it is good that other countries and jurisdictions aspire to become the leading player in this field. I think everybody has to find his or her niche, and from that point of view, with regard to wealth management, where we really can have a level with regard to the question of how we shape our portfolios, there we have a good chance of being successful. First of all, because we are the world's largest wealth manager. And second, you have to look at the framework conditions. The framework conditions in Switzerland are excellent, not only with regard to know-how. From an academic point of view, Switzerland is the country with the highest densities of universities worldwide, and they all think about these kind of questions, as we can see through the fact that the academia is present here today. And then also with regard to the framework conditions that I have just mentioned, if you are able to shape the framework condition in a favorable way, then I think and I believe that we can play a role globally in that field that I just mentioned, and also hence have a certain impact globally with regards to the common goal to reduce climate emission.
Thank you, Jörg, for this comment. I would want to continue with a question that goes to Bjarne and your comments on green bonds. Franz Knecht says the key issue of green bonds are taxonomy. There's a lot of confusion and diverse interests involved in what is out globally today? What will be needed to improve and further strengthen such products? Bjarne, over to you.
Yeah. Thank you for that question. I think with green bonds, that's one of the issues about green bonds discussed since the beginning is how can we design them in a way that there's actually a climate impact at the end. And that, of course, comes down to the use of proceeds. Are these proceeds really being used for additional green projects that maybe wouldn't have been realized without? And are these projects really green? So are they what the investors assume or that the green stands for? And in that regard, I agree. This was a dynamic development, also diverging a bit between Europe and China, which is a huge market for green bonds, but with a somehow different understanding of what green could be. And to clarify this confusion, I think this is exactly where role of government comes in, like this defining a taxonomy together with financial market actors, of course. That's what happens on the EU level. It's not bureaucrats that decide on their own, but there's a technical expert group and other committees. But somehow sealing a clear taxonomy, what is sustainable, what is not, along economic processes, even if that's not perfect and might have to change again over time. But giving clarity there, I think that's a great contribution to both ensure there's an impact and also increase trust in the instrument.
Thank you, Bjarne. Well, we will dig a bit deeper on the taxonomy just afterwards. First, the question to Urs. The question from Ivo Biri says, in what way do the Swiss insurers take ESG criteria into account when it comes to real estate investments? On the slide that you showed, you mentioned that 90% of those investments already take it into account. Maybe you can tell us something about the level of ESG integration. As we know, the Swiss building park is not yet on the kind of level we would want it to see.
Yes, thank you very much for this question. It's a very good one too. As a matter of fact, the insurer started with general investments on the asset side, and the real estate park is taking more time to be adopted. You have a certain investment and you can't renovate and adopt your portfolio within 1 year. It's taking over time. So they're starting with guidelines, how they want to develop the real estate park, and it's taking afterwards several years to really adopt them, which means some of the investments you sell, others you buy that are according, and a third group, and that's the large part, you do that via renovation. And we're certainly not at the same point at the moment, but it's as with general investments, but it's on the agenda and the Swiss insurance companies are moving forward. We plan for the next report next June to comment further on that where we are.
Thank you, Urs. Now, a further question on the taxonomy that I would like to hand over to Jörg. It's from David Guthorl and says, when will you see a profound Swiss answer to the framework? Are we ready for its implications towards Switzerland's institutions? So how about the role of the taxonomy for Switzerland?
The EU taxonomy plays, of course, a crucial role with regards to what we do and what we would like to achieve in Switzerland. But one should not underestimate the impact of the EU taxonomy. It doesn't only concern the financial sector, but it concerns the whole economy. We are very much involved now with the different stakeholders to try to find out or conclude what exactly it means with regards to Switzerland and the framework conditions that need to be changed in order to live according to the EU taxonomy, in what way we would like to take over this huge compendium of ideas and measurements that need to be taken in order to turn around our economic system. It is basically a recipe how to turn around the whole economic system. And that's why I believe that it is indeed something quite gigantic to implement. And we need to analyze this further. It is not only the financial sector that needs to get acquainted with the EU taxonomy. It's the whole economy, and that will take some time. When will we be ready? I think there will be no precise date to be mentioned. I think the implementation part of it at least already happens, and it is a process. It is not something binary. You fulfill or you don't. It's something that we have to introduce. These are guidelines. Some will be taken over, others probably not. And the work is currently going on, but to issue a date would probably be very, very courageous to do that.
Thank you, Jörg. Well, I'd like to follow up with a question that relates to a similar topic. Paul McIntosh asks, you recommend harmonization of standards to drive the whole thesis. What prospects do you see for consolidating the alphabet soup of standards that BlackRock and others have complained of? I think it relates to a similar topic, and if I may follow up on that myself, SSF in Switzerland has a work group in place to come up with recommendations of how to provide transparency on sustainability of portfolios. And in that, we of course take into account what we see going on out there. For example, the recommendations related to the EU regulation. There we probably don't have to speak of recommendations, but more obligations. But we also see recommendations still on the level of TCFD. We most recently saw an initiative by CFA, who aims to standardize the whole terminology around sustainable investing, an initiative namely that we welcome quite a lot, and we also provided input on it. So I think in all of this, we just have to see it takes time, and we see a lot of players coming into place and contributing their share to clarifying the terms, both the terms, but also the definitions, and it's definitely something we at SSF also work at. Now, I have one question that I find very interesting and I would like to hand on to Bjarne. It's from Oliver Marchand. Do you have evidence that incentives work better than regulations? What's your view on this, Bjarne?
I mean, that's a very general question. And the devil there is in the detail, I think, and the answer varies on what you talk about. I think if we talk about the real economy, the polluting sectors, so there's, I mean, as Jörg Gasser rightly pointed out, the transformation in the end, it's not just the financial sector, but it's also the real economy for which the financial sector maybe allocates capital. There's many examples where incentives, targeted subsidies also worked well to bring new technologies to the market, talking about solar PV, for instance, other renewables, where incentives maybe have been more effective than regulations, portfolio standards, or that like. If we talk about the financial sector, I think that's still an open question. So far, we see a lot of regulations around disclosures and disclosure requirement, a reporting requirement, sometimes also risk management requirements. We see very little financial incentives yet, and I think that's to be seen. Also concerning innovation in the policy sector, because it's a quite new field, these green financial policies, to see if their incentives come up. But to date, I think it's we see a lot more regulation and information policies and government market activity. As I said, that's another big aspect in that regard.
Thank you, Bjarne. So a rather general question with maybe a bit more specific answer. I would like to take one last question before we close, and it's around the social question. We discussed about climate change mainly today, but I mentioned the COVID crisis that we're in at the beginning. So this question from Maria Castillo is, how can we ensure a just transition towards a low carbon economy? Is it through participatory across relevant actors? Is that enough? Or do we need a more integrated framework? I think it's always this difficult question of how to balance environmental and social aspects or even make them work together. Who would want to very briefly comment on this before we close? Can I maybe hand it over to Jörg to finish off? How do we get it just this whole transition? Jörg, you're still on mute.
Yeah, sorry. Can you repeat the question, because I don't know if the other listeners realize it as well, but you were cut off for us at the crucial moment. And I cannot find the question on the F&A. Can you repeat it, please?
I will. The question is, how can we make sure we see a just transition towards a low carbon economy?
Okay. Well, I think what is extremely important is to consider not only the E but also the S. The S and G they refer very much to the question of justice and fairness. And to focus on the E, you run the difficulty that you would like to change as fast as possible in order to save the climate or to save the planet, basically. And sometimes you underestimate the effect it has on S and G. And that's why I think that the global development goals that were set out by the UN, which is really which symbolizes a holistic approach, is the right way to go. You need to find the right balance between E, S, and G. And if you achieve that, then you get this kind of fairness that the question implies.
Thank you, Jörg, for making this big frame of referring to ESG, something that is always crucial in our communication too. So it's already 2 minutes past 11, and we unfortunately have to stop here with the Q&A session. And I would now just like to say that there will hopefully be other opportunities to continue this discussion. We know climate change won't disappear, it's here to stay, and the questions around the role of finance as well. So I hope there will sooner or later be an opportunity again to dive deeper. By the way, over the coming weeks, we will publish a total of 10 short films that present different instruments of this report. So please check out our website to find them all over time. But let me finish now with saying thank you. I would like to thank all the authors that contributed to the report that we presented today. I would like to especially thank the steering committee that guided this work, the SSF team that reviewed all the contributions. I would, of course, like to thank the speakers that provided such relevant insights in today's webinar. And last but not least, I'd like to thank all of you who joined us for this SSF webinar. We look forward to soon being in touch again with further information on sustainable finance. I wish you all a very nice day, and I say goodbye.